Good morning, everyone. I would like to welcome you to this edition of Leading Indicators. I am Russ Allegrette of Ocean West Capital Partners. Joining me, as always, is Dennis Kiely from DLA Piper.
Good to see you, Russ. Good to see you, Andy.
We're really fortunate today to be joined by Andy Hundertmark. Andy is CEO of Argentic. Argentic does a lot of different things, but one of the things that they do, and we're going to be talking about today, is they are one of our country's largest special servicers. I've known Andy for a long time. He's had decades of experience in and very well known in the special servicing industry from its inception. So we're really fortunate. So thank you for being here, Andy.
Thanks for the invite.
Why don't you just kind of give a little bit of an overview of, your background, and then talk to us a little bit about Argentic and specifically, what they're doing in the special servicing world.
One point of clarification, I'm CEO of Argentic Services Company, which is actually the
Okay.
special servicing entity. There are
Okay.
a number of Argentic affiliates that do other CMBS related, not special servicing business. So I've been on the dark side, as we call it, since I guess the early 90s with the RTC. Most recently, prior to Argentic, spent 14 years with CW Capital, one of the other large CMBS special servicers working out there. I was hired in mid-19 to start Argentic Services. We opened our doors in early 2020 into the teeth of COVID, which was quite an interesting baptism by fire, if you will. We've grown steadily, most of it organic through assignments, special servicing assignments from one or more of our affiliate companies, although we do have a few institutional clients as well. Today, we are currently the name special on 59 transactions totaling $33 billion, covering 1,368 loans secured by 2,040 properties, basically in all 50 states, all product types in the commercial real estate world.
Wow, that's impressive.
With heaviest concentrations, as you would expect, California, New York, Texas, Illinois, Florida.
That's great. Maybe for some of our people on here, maybe it'd be helpful just to kind of go into a little bit about what a special servicer is, what you do as a special servicer, how you interact with the different pieces within the capital within a CMBS execution.
Sure. So special servicer, I guess, has two distinct but related roles. One is when a loan goes into default or imminent default, it will transfer into special servicing for whatever may happen, whether it be a workout, whether it be foreclosure, whether it be a note sale, any number of solutions that will help us maximize the recovery to the trust. The second piece of it is what we call performing loan consents. And those are requests coming in from borrowers that run the gamut from lease approvals to, in these days, what we're seeing a lot more of is insurance adjustments, i.e. wind coverage that's unavailable or storm coverage that's unavailable or priced out of the market, whatever. Easements, eminent domain, those kinds of things. That is something that's ongoing on a daily basis, getting requests in. They come in through the master servicer. There are some requests, depending on the pooling and servicing agreements that govern the trust. There are some borrower requests that can be handled at the master servicer level, but most what they call major decisions must come into us, and we then write it up, make a recommendation, and then pass it along to the controlling class representative who has the ultimate decision-making authority.
Andy, can you tell us a little bit about the trust itself? For some of our listeners, they probably heard the trust term thrown around. What exactly is it?
I won't get into too many details just because that's not my forte, but an issuer, in most cases, a large bank that has a division that does nothing but handle CMBS securitizations, pulls together new loans from any number of issuers, typically 5, 6 to a trust from various parts of the country. And they form a trust. And these loans are contributed to the trust. And then the rating agencies, Fitch, S&P, et cetera, look at the trust, look at the loans that are in it, look at the cash flows, et cetera, and tier bonds that are secured by the cash flows in that trust. And obviously, you've got AAAs at the top, and at the bottom, you've got what we call the B piece, which is the riskiest piece. Obviously, if things go as they should, the best return, but the riskiest piece. And that B piece holder is then has the ability to appoint the special servicer to handle problems and ongoing borrower consents within that trust.
Can you just clarify for us, what's the difference between a B note and a B piece? And obviously, there's some large loan securitizations, a SASB versus, an aggregation of a bunch of loans. Can you just kind of talk through those two different things? Because a lot of, our clients actually participate in large loans. So, they do have standalone securitizations.
Yeah, so and we are named on several SASBs, as we call them, single asset, single borrower. And in many ways, they're not too far different from a CMBS aggregation. There is a controlling class at the bottom of that bond waterfall, the B piece, if you will. And those bonds are not necessarily the B bonds, but they've just over time, that's the nomenclature, the B piece. The owner of that B piece, the owner of those non-rated bonds, again, has control over who the special servicer will be, whether it be a CMBS trust or a SASB trust. And you have the master servicer, which is a bid type situation, and typically it's Wells or Key or Midland, Berkadia are the big players in the marketplace, and they handle the day-to-day servicing, if you will, payment processing, escrow management. They're the primary point of contact for the borrower on an ongoing basis. And a borrower that doesn't ever default, which are the majority of CMBS borrowers, will never really come in contact with a special servicer other than perhaps, as I said, a lease approval or something of that nature that finds its way into our shop. The master servicers, again, are the day-to-day custodians of our world.
A quick question in terms of from between the master servicer and the special servicer, when does the special servicer typically step into or take over the leading position in terms of servicing a loan?
Yeah, there are very particular triggers laid out within the pooling and servicing agreement or within the trust and servicing agreement in the case of a SASB. Obviously, a payment default is the primary driver for a loan transferring in. And that payment default, the transfer doesn't happen the day after the payment default. Typically, I think most PSAs have a 60-day window before it would come into us. But a payment default is the most typical. You'll also get it for non-payment default on occasion. Those are a little trickier, frankly, from a special servicing perspective, because borrower's still paying you. And so if you walk into court to try and enforce something, the judges really put a lot of stock in the faith that they're getting paid every month. It's a difficult situation when you don't have a payment default. And then imminent default, which is where a borrower may reach out, typically through a representative that they've hired who's conversant in the ways of CMBS, and says, hey, I've got an issue. I need to come in and talk to you guys. Maybe it's a large tenant that's blown out. They're about to go into default, or they've got a lot of money in escrow and they haven't met the terms of the escrow release, but they want to talk about it anyway. So those will come in on a kind of an ad hoc basis. And then the other way, as I said, are loans that don't transfer in, but performing loan consents where we're asked to make a recommendation to the CCR, to the controlling class, the B piece holder, for a particular course of action. Again, pursuant to the PSA terms or the TSA terms.
A lot of people may not realize that going through the process of distress within CMBS world, it's relatively new. I mean, the first real major instance of doing it was during the GFC. And I think there were a lot of lessons learned during that period of time and a lot of changes, significant changes that were made after that. Everybody from, the sub-debt perspective and the borrower perspective is, trying to understand what some of those major changes have been in terms of how, you can do things in being a special servicer in CMBS. Can you take us through some of those major changes in CMBS 2.0?
CMBS has continued to evolve. Some may say improve, some may say worsen, but it's an ever changing animal. I think the fundamental role of the special servicer has not changed. Back in the 1.0 days, I think the specials were much more empowered, might be the right word. We could call for a loan to come into special. We didn't have to necessarily wait for a trigger, a default, if you will. If we had a concern, we could bring it in and address it proactively. That's a good thing in certain cases, but it's certainly a power that can be misused. The fundamental tools that we use in special servicing are the same as they were, GFC or pre-GFC for that matter. I think one thing that's really changed is the underwriting standards, by and large, have improved significantly. When you go back to the GFC, you had a lot of highly levered deals, and they were highly levered the day they were made. It wasn't that the GFC drove collateral values down and that hurt them. They were potentially ill-conceived from origination. Right. And the stuff we're seeing now, the maturities that we're seeing now, by and large, your LTVs were fairly conservative 10 years ago. Yeah, you still have some full-term IO stuff, but you also have some amortization, more amortization than you had in the, again, coming due during the GFC or even during term defaults during the GFC. I think the biggest difference is probably the B pieces became very liquid, I guess is the right word. Or maybe it's not the right word, but the B pieces were heavily traded, let's put it that way, in 1.0. And so a lot of people came into control that were not around when the trust was originally put together, when the bonds were originally issued. They came in later, they had a different basis in their investment. They had a different motivation and different ideas to what they wanted to do when loans came into default. And there were, there were fair value purchase options that drove a lot of decisions. It got pretty crazy, honestly. And
very politically correct answer.
Yes, so I think the biggest change now is really that if you as the CCR want to buy an asset that's in special, you pay the freight, you pay the full UPB, costs, expenses, everything. So that option's still there, but it's not nearly as attractive as it was back in the day. And I think it's, by and large, I think it's made CMBS better. Would I prefer going back to 1.0? Sure, as somebody that's got a P&L to watch, absolutely. Yeah. But I think, from a borrower perspective and really ultimately from a bondholder perspective, I think we're in a better place now.
It's a great point you bring up. I believe one of the protections now that's there that wasn't before is there's a limitation or there's provisions in terms of how control goes from an appraised perspective from one class to another. And it's now, and correct me if I'm wrong, but before it used to be just the bottom class that was in the money that would control. And today, you actually, in a lot of securitizations, once you get below a certain level, that control actually goes to the servicer. Am I saying that right?
Yeah, well, yeah, and you've touched on another area as well that's a big change that I neglected. Again, back in 1.0, a loss did not occur until it actually occurred, till you sold that property at a loss or till you sold the loan at a loss. And those losses would then add up. And if they hit the proper formula, then the original B piece holder would be out and the next guy up the stack would be in charge, and he'd be in charge until he got wiped out, et cetera, et cetera. Today, those losses can occur on paper. through an appraisal. So an appraisal reduction is a real force in today's CMBS world. It's not when you sell the property, although there may be an additional loss when the property's sold. It's what that appraisal says it's worth today. And again, there are very definite timeframes built into the PSA as to when that appraisal needs to be ordered. What triggers that appraisal? Not necessarily a transfer into special. It may be 60 days after a transfer. It may be 60 days after a default. Number of different factors that play into it. So that's the most important change. And to your point, yes, today, if that B-piece holder is appraised out, whether through real losses or appraised losses, yeah, there's a concept of an operating advisor, which is a new concept in 2.0. And that operating advisor then takes a more active role overseeing the special servicer, who does have a lot more decision-making authority once that original B-piece holder is out. And again, it varies across PSAs, but generally, once that B-piece holder is wiped out, then the OA steps in and takes a more active role hand in hand with the special servicer.
Hey, Andy, yeah, I've got a quick question on receivers. How do they differ from special servicers? When do receivers come in? Who decides?
So typically in our world, we decide when we want to go to the court to get a receiver. Now, ultimately, the judge decides whether we get that receiver or not. And depending on the state and the judge, that can be easier or harder. But typically, we will look to put a receiver in to control cash, get control of the collateral. Not that he's under our control. He's an officer of the court, and that's where his responsibilities lie. But they really lie toward protecting and preserving the collateral, which is what I, as the lender, care about, right? So while I can say, hey, I want Joe Smith put in as receiver, Your Honor, Your Honor can just as easily say, no, I don't like Joe. I want to put in this guy. We use receivers quite a bit. Use them more in today's world with the interest rate increases. If we can keep the debt alive and not foreclose, we have had a couple of successful sales of collateral with the debt being assumed, and the receiver has overseen that sale, if you will, under the auspices, again, of the court. The judge has to bless the sales process and the ultimate sales price, but that's become another tool in our toolbox now with rates being so much higher than they are. There's a real value to, 200 or 250 basis point interest rate reduction, if you will.
Or even the availability of debt right now, right? I mean,
or even if you can get debt on it, right?
Yeah.
So, but we use receivers quite a bit whenever we get the opportunity. Really, they don't work in all cases, but we've had a lot of success with them.
So maybe we get to a little bit of just kind of what you're seeing in the market. Obviously, you see things before the market sees things, and you're monitoring, what's going to happen versus what the market's seeing. I mean, where are you seeing distress right now? Geographically, more important property, property type. I'm sure we're going to hear office a lot. So what are you seeing, and then what's coming?
Argentic Services is somewhat unusual in that the majority of our named book was originated in 2017 or later. So we don't have a lot of maturities. We have some 5-year stuff, and we have a couple of older trusts where we've had some 10-year maturities. And most of the distress is in the maturing world, right? If you're coming out of a 4.5% loan and you got to roll into a 7.5% loan, and you've been IO for 10 years, and the cap rate on your properties shifted by 200 bips, you're in trouble. And we've seen of the loans that have matured in our portfolio, a fair number of them have come into special for that very reason. But in terms of term defaults, again, borrowers are doing whatever they can do to try and keep that low rate paper alive and survive to 25 or whatever every year you come up with a different one
Right, yeah.
to get you to the next year, right? So,
Right.
but
Kicks to 26, right? You kick it out to
yes,
26.
exactly,
Yeah, I hear it.
exactly. But
Yeah.
so, but as you would expect, most of what we're seeing is office. We have a couple hotels, and multifamily is something that we are starting to see, and I think will be a problem for the industry moving forward. Historically, Freddie and Fannie tend to get the better multifamily deals, right? And the properties that come into CMBS are B and C quality typically. And over the past few years, people have a lot of syndicators out there. We're buying properties at 2 caps, 3 caps. And with the increase in insurance and the increase in other operating expenses, those properties just don't pencil anymore. And the syndicators don't have the ability to go out and get new, contribute new equity to the deal. And so those I think are going to be a problem. The multifamily industry as a whole is great, but there are going to be, as in anything, there are going to be dogs that are going to come out for any number of reasons, and we've seen a few of those. But that being said, they come in and they're not nice properties, but we get a dozen phone calls from prospective buyers the day after they come in. So multi's something everybody seems to love. Not seeing anything in the industrial world as you would expect. And retail, occasionally you'll get, maybe a big box that's gone empty, something like that. But we really haven't seen much recently in the retail space. That seems to have, the lack of any new supply over the past several years seems to have helped that industry greatly.
When faced with distressed loans, what do you see borrowers currently doing on their workouts? So they agreeing to increase rates, pay downs?
So occasionally you get here are the keys, right from the get-go, and whether that's posturing or whether that's I'm really done, take them. You have to kind of have those conversations and figure out where they're coming from. Typically when a deal comes in, again, whether it's a maturity or a term default, we're going to look for new equity to come into the deal. And whether that's delevering or whether that's topping up escrows, every deal's different. And, where the money goes, as long as it's under the lender's control, it doesn't matter so much. We look for a significant new equity slug. We may look for some recourse to the principal or principals to cover some portion, maybe all the loan, but at least some portion of the loan. And we look for, we're kind of re-underwriting the deal, right? What's your plan? Why this loan here? Is it strictly a maturity problem and you just, 7.5 debt just doesn't work on this property right now and you need some time? Okay, if we give you some time, what are you going to do? You got new tenants lined up? Are you going to fix up the property? What's the plan? Why should we hang around with you, Mr. Borrower? And many times the answer is, yeah, the borrower's been paying us for 10 years and let's let him pay us for another year or two and see what happens. But sometimes the borrower's not willing to hang in there or not able to hang in there. They just don't have the money to put the equity up. And, maybe they've been out in the market and they've priced pref equity that it doesn't work. With the cap rate compression, there's been a lot of people, just don't have any equity left in their property. So why should they continue to feed it? Maybe they better to fight another day with another property.
And Andy, are you seeing the initiative come from the borrower side in terms of a plan, or do you oftentimes get approached by the borrower saying, we don't really know what to do. Can you give us some suggestions?
I would say both. CMBS borrowers kind of run the gamut, from ma and pa to sophisticated institutional investors. And so as you would expect, the institutional guys are coming in with a plan. And maybe that plan is give the keys back, and that's it. Yeah. We're done. but maybe that plan is, here's 30 pages. Here's what we're going to do, guys. So it really runs the gamut. And you got a lot of advisors out there who will represent borrowers when they come into special servicing, some better than others. And hopefully they can help the borrower pull together a coherent plan and be their advocate with the special servicer and get something done.
I think, and I'm sure everybody here is going to agree with this, office is a unique challenge in that, one, obviously fundamentals and work from home have changed. It's kind of a double whammy in office in that there's been an impact of obviously the interest rate increases and the cap rate increases, but the fundamentals have changed. And one of the things unique about office is it's capital intensive. So, in a multi, you could come in and go, hey, look, I think the market's going to get better. And yeah, we got to paint and carpet a unit. And, but on an office deal, you may have to put in $150 a foot to lease a building. I guess my question with that is, how do you look at that? And one of the things that we saw a little bit of, and I haven't seen a lot of it yet, but I think we're in very early days on how these things are going to be restructured. But, before people would look at an A-B structure where, you as a servicer are sitting there going, look, there has to be more capital put into this if we believe in value appreciation, but putting that money at the equity level may not make sense. Are you guys looking at so an A-B structure would be you put it in at, a lower level in the debt stack, create kind of an A note where you pay current on, you put in equity or preferred equity, and then some of the loan goes behind the preferred equity piece after a preferred return. Are you seeing that, or how are you dealing with situations where you're undervalued and capital is going to be needed to actually stabilize the property?
We have not done any ABs in this go round. I have heard from some of my colleagues in special servicing and in the borrower advisory world that a couple have been done and probably more than a couple have been proposed. I certainly think it's something that could absolutely be appropriate. I mean, to your point, if you've got a fundamentally good property and you've got a good borrower who's willing and able to bring some cash to the table, but he's going to say, I'm not putting this behind $100 million. This property's it's worth 50 today. If I really work it, maybe I can get it up to 70. So, let's talk 50 million. And that's probably a very reasonable ask on their part. We've not come across that yet. I don't think it'll be as prevalent as it was in the legacy in the 1.0 space. Again, and some of that really is related to, again, that concept of losses, right? And if I did an AB note back in 1.0, there wasn't a loss because I have a B note. So I have my full principal still outstanding. There's no loss until that loan's paid off. Whereas today, if I cut an A note at $50 million on a $100 million loan and the appraisal says it's worth 50, there's a loss. Bonds get impacted, the payments to the bonds get impacted, and if enough losses occur, the control in that trust will be impacted.
It's an interesting situation in that when you have a control piece at the bottom and someone comes in on an AB, but there's a higher appraisal in the stat, that's sitting out there.
Mm-hmm.
I could see how an AB could actually knock out the control piece, which could be an issue. Although if the control piece is already appraised out, it may be easier for you now as a special servicer to go in and structure an AB than it was before. Not saying that it's current or not, or am I reading that correctly, or am I not reading that correctly?
I think you've made a good point there. At the end of the day, and I know this sounds sounds trite, but we're going to run our net present value analysis, and that's the path we're going to go down. And if the AB note makes the most sense, and again, we think we've got a good borrower that's knowledgeable vis-a-vis their property and the market, and they've just been caught in the macro whirlwind, then we're going to be more likely to try and carve something that makes sense for both sides. But what we've seen to this point, we just haven't really felt like we were underwater enough to justify going that path. But again, we don't have the volume in the maturing world that some of our colleagues in the special servicing space has. So I think you're going to see more ABs coming out of that maturity cycle than mid-cycle defaults.
Great. So I have a question on mezz loans and prep equity. Are you seeing any situations where the mezz lenders are stepping into via UCC foreclosure into the ownership, or prep equity is exercising their rights in the operating agreements to step in? How's that dynamic if you're seeing those new sponsors come in?
We've not seen any pref equity step in. We have had 2 instances where we've had significant mezz behind us, and in one of those, the mezz stepped in, did a UCC foreclosure, and is now our borrower and paying as agreed. And I think they're happy, and we're happy. And then we've got a transaction we're working on now where that looks like it's going to be the solution, where it's a very capital-intensive office property that the borrower has somewhat reluctantly walked away from, but appears that the mezz is going to step up and step in.
It's an interesting situation because sorry, Dennis. Last episode we had Mike VK on from Eastil. He was talking about how it's the first step of any borrower is to value the property and to see, kind of where we're at, and not only where the value is today, but where you think you can get the value and how much capital. And by virtue of the fact that, you're at a different level of value, being a mezz player versus equity or preferred equity, or even, on these larger loans, you're seeing that there's A, B, C, mezzanine pieces, and there's a very significant basis difference there. I could see that happening a lot more, where the mezzanine position will have a decision point where they have to decide, and it's a different decision point than the borrower, where do you put more money into this? Because, and I guess the question here, Andy, is, and I think I know the answer, but you probably treat the mezzanine restructure of the loan or a potential restructure loan similar to a borrower, where you're going to expect them to come in with money, you're going to expect them to come in with a plan, and you're going to expect your expectation, you said it before, was on NPV. Your expectation is going to be, okay, you're coming in with all this stuff. For us to make a modification, things have to be better in 2 to 5 years than if we sold it today. Is that how
Absolutely.
You look at it, and that's your decision point?
Yeah, no, it's, just because you're the mezz lender doesn't give you, carte blanche to just step in and continue. You've got to have a plan, and you've got to have the capital to back that plan. It can get a little, the mezz senior lender dynamic can get a little dicey.
I mean, we're hearing, the concept of a deed in lieu of foreclosure, and, there may be a way where if there's not a lot of value, and the mezzanine player may not decide, because the mezzanine player obviously has rights to cure a loan or purchase a loan, or, there's ways for a mezzanine player to actually get through a situation through the loan documents. And I'm talking more about the purchase of the loan, because most of these problems, as you said, are maturity problems. But there are situations where, especially in long foreclosure states, you're kind of sitting there as a mezzanine borrower in a long foreclosure state, and you may be falling asleep because you think, okay, I'm in New York or somewhere where it may take 2 years of foreclosure. My mezzanine, I'm sitting in the catbird seat because, I can do it in 60 days, right? But
Hmm.
that may not be true in that, there is the device called a deed in lieu of foreclosure where, guys sitting in your position may be saying, look, the market may be worse in 2 years, or we may be wasting this asset because lease term is, getting shorter and shorter. I mean, do you have that ability to take a deed in lieu of foreclosure and take a payoff and essentially, negate those mezzanine rights?
Yeah, I guess you have the ability. My experience with deeds in lieu in general is that they take time. They take more than 60 days because there's negotiation.
Yep.
What are you going to release me from? It being the biggest bone of contention. And then two, if the mezz has good documents, that borrower is probably leaving themselves open to litigation from the mezz, maybe on a personal recourse basis. So yes, the deed in lieu is always something we could take, but as I said, my experience is that it's, except in New York and some other states, I'd rather foreclose and
Yeah,
get it over with.
understood.
I got a really quick question, Andy, on bankruptcy. Have you seen any bankruptcies yet where the borrower is using the courts? And typically in real estate, we have a process where single asset real estate, it kind of goes through expedited basis, but that's not always the case. So just curious, Andy, with any experiences you've had with the bankruptcy process.
This go around very little because
Yeah,
I think part of it is that bankruptcy is now a personal recourse trigger in virtually every CMBS loan. And so you really have to think long and hard about the consequences of throwing a single asset entity into bankruptcy and potentially triggering recourse to yourself. And whether that has financial value, it certainly has psychic value. So we've seen a couple, but we've been successful in getting them out. I mean, to your point, in theory, there are single asset bankruptcy rules that most SPE bankruptcies kicked right away, but nothing seems to move quickly in the courts these days.
I guess the last question just for you, Andy, is, a lot of times it just feels like a black box working with a servicer. Do you have any advice for, and the other side too? I know as a servicer, it may be difficult to sometimes work with some of the borrowers and even like the mezzanine players, to figure out if someone's interested or not, or if someone's real or not, or is there any advice you have for either borrower slash mezzanine player in dealing with you, or is there, any things that you wish people would do to deal with you differently?
I think that, from a borrower's perspective, being proactive vis-a-vis your lender, if you see a problem coming, whether that's a maturity, whether that's a lease expiration, a casualty event, whatever it may be proactive with your master servicer, and don't be afraid to request a transfer to special if there's some significant action that you need taken, because time is not anybody's friend. Typically, you want things to move as quickly as possible. So communication, honesty is more likely to get a deal done than not. I do agree that from the borrower's perspective, it can be very frustrating dealing in CMBS. The master servicers are not always as forthcoming as they should be, and it's easy to get a hold of. And once you come into special, I've heard from many people that it appears to be a black box. I tell prospective employees when I interview them that you will answer the phone, or you will return voicemails, and you will return emails, and you will do it promptly. And you don't have to solve the question, solve the issue right then and there. But if a borrower reaches out, they need to know that somebody's going to pick up the phone. And borrower experience is always been a problem in CMBS, and it's to all of our benefits in this world to make borrowers as happy as possible, because the majority of them pay their loans as agreed and pay them off as agreed and roll into new CMBS loans, and they're the ones that we need to keep happy.
I think this has been great, Andy. I think you've explained it in a great way and shed a lot of light on a complex and not well understood topic. So thank you so much for your time. We really
Welcome.
appreciate it.
Welcome. My pleasure. Enjoyed it.
Thanks so much.